Hey, what's up, everybody? We are going to do one of the lessons for this week. I'm going to explain to you about something crazy that happened, which was the price of oil. So you're going to watch this video and then answer the related forms um, to kind of go over what what we discussed today. So something crazy happened on Tuesday, Monday, and Tuesday, and that's the price of oil actually went negative. So I'm going to explain to you kind of what's going on here. I'm going to draw some supply and demand curve items for you to try to explain to you how the price of oil could actually be negative. So there's something called futures, and futures are an agreement to buy an amount of something at a fixed price. So this is something that um, businesses do to try to plan. So businesses use this to try to plan for the future. So if you are a company that uses a lot of oil, say you're an airline company or you're a trucking company, you buy your oil a month in advance and you pay for it so you know how much stuff costs. And you're able to do this. Some of the things that you're able to do this with include hogs, soybeans, corn, as well as oil. So you can buy this stuff in advance. And when you buy a future contract, you're agreeing to buy a certain amount at a certain price. So, for example, the price of oil could be I agree to buy an example would be I agree to buy 10 gallons of oil at a price of $30 a gallon. All right. So this is something you can actually do to invest or kind of speculate on what you think is going to happen. If you think the price of oil is going to go up, you can buy a future for 10 gallons of oil at $30 a gallon. And next week it's at $40 a gallon and you can sell that to somebody else. So to get a future contract, you need the quantity, how much you're going to buy. So for the example here, it was $10. You need the unit amount. So that would be an example. We're going to do, that would be the example of gallons and the date that it's going to be delivered. Now, these are normally 1 month in advance. So I would, on April 20th or April 21st, the futures for the next month to be delivered in May would be closed. So why do people do this? This is the way that they can budget and they know how much stuff's going to cost, because you should see that in your own lives in terms of if you knew what the price of gas would be for the next month, it would be a lot easier for you to budget as opposed to the price of gas going up or down a certain amount of money over a period of time. So this is kind of what was going on. So people are buying and selling these future contracts. Now, what gets crazy is there has been a huge decrease in demand for the price of oil. And this is kind of what the price of oil has looked like over the lifetime of, this is called West Texas Intermediate oil. This is oil that was made in the United States. So if you go and see what the price of a gallon of oil would be, it was $18.95 per gallon in January. It got in 2008, it got all the way up to $139.36. So this had gone up and down and it had fluctuated, and this is all based off of supply and demand. So we are going to, which everybody loves, going to draw the old supply and demand curve. So we're going to look at this. So if we're looking at the supply and demand curve, and remember quantity price. That's quantity. All right. And then we have the demand and the supply. And I apologize if this doesn't look great, but the downward supply is there. So what happened on Tuesday was unprecedented because there has been a huge decrease in supply or demand because people aren't driving. There was something they estimated that there would be something in the range of a 20% decline in demand. And remember, anything that happens in a decrease in demand would shift the demand curve to the left, and we get a new price equilibrium. So what should happen is the price of oil should fall and the quantity should fall. That would be what would actually happen in the world market. Now, something crazy happened in this as well. And what happened was Russia and Saudi Arabia and the people that produce oil got into a war. And they decided, hey, we're going to start pumping a ton of oil. So the demand is down. Remember, demand is down. And then what happened was they said, hey, we're going to start pumping an extra $10 million worth of oil. And the supply went up. So if we're on this curve again, demand, supply, the demand went to the left and the supply went to the right. And now all of a sudden, the new equilibrium is way down here. So you have a huge amount of supply, and you have no demand for it. The crazy thing about all this is that once you start pumping oil, you have to, if you buy oil future contracts, so I'm going to put this down here. If you buy contracts for oil in the future, you actually have to take delivery of the oil. So for example, if you bought a future for 200 gallons at $30 and you actually have that contract when it expires, you have to have somewhere to actually get the oil. So in this scenario, and I'm gonna go with the old Saul here. So I'm an investor and I'm sitting there and I decided on April 1st to buy 500 gallons at $30 a gallon. I bought a future for this. All right. So I just spent $15,000. And I'm hoping that the price of oil, my hope is that it goes to 40. And if it goes to 40, I could sell those contracts and get $20,000. Now, here's the problem that happened. We're sitting here in an unprecedented time and nobody wants this stuff. And all of a sudden, it's April 19th, April 20th, and I have a contract for 500 gallons at $30 a gallon, and nobody wants to buy these. So I'm sitting there, and if this expires, I'm going to have to find a place to put 500 gallons of oil, and I'm going to have to sell it, or I'm going to have to take physical. If on April 21st, I still own these, I have to take physical they give it to me, and I have to take the physical oil. So I would have to go pick up 500 gallons of oil and store that at my house. So I'm panicking at this point. And remember, what happens in a panic? In a panic, we say, all right, I can't get rid of something. The law of demand says if we can't get rid of something at a higher price, what do? We lower the price. So the price went from $20 to $10. And then all of a sudden we're saying, you know what? Like, I can't do anything with 500 gallons of oil. Like, I'm screwed. I will give you that $500 or 500 gallons of oil for free if you agree to just take it. But there was so many people that were doing this that the price actually got to, and wait for this, price actually for a gallon of oil got to negative $37.92. And what that means is, I got to do a little math here on my calculator. What that means is I have to pay $18,960 for somebody to take my oil. So overall, my net loss here is not the $15,000 that I paid plus the additional $18,960 for somebody to take my oil. So I don't have to take physical I'm blanking here. I apologize. I physically take the contact or the oil to do it. So I actually, for $15,000 I invested, hoping that it would go to $40, I now am down $34,000 approximately. And that's the crazy stuff that's happening. So just to give you a couple like summaries of kind of what this means. Number one, this doesn't mean that the price of gas is going to be $0. They're not just giving away gasoline. That's not what the point is. The future contracts for June, which expire in May, are still somewhere in the range of $20 a gallon because they expect with the stay-at-home order that that people are going to start driving again. And the second thing is Saudi Arabia and Russia came to an agreement to decrease oil production by 9.7 million barrels of oil. So you're going to see obviously less supply and hopefully increased demand for the month of May. But this stuff up here, where the price of a gallon of oil actually got to negative, where people were paying to have somebody buy their contract so they didn't take a physical shipment, was the word I was looking for. A physical shipment of oil was something that was crazy and unprecedented, and it was something that caused the stock market to drop over the last couple of days. So hopefully this explained this to you, and you learned something that was something that happened that has never happened before in the land of oil and in terms of commodities and trying to buy and sell stuff. And hopefully you learned something new. Please go to the Google form in order to answer questions. And I need to stop this, hopefully.